As president of the foundation, it's my pleasure to be part of today's webinar, as it lifts up one of Berkshire Taconic's core strengths, our investment program and the talented people behind it. As a philanthropic institution, Berkshire Taconic and our fund holders use grants and scholarships as their primary tools to achieve outcomes important to the communities we serve. As stewards of these charitable funds entrusted to us, the foundation is committed to seeking the best possible returns while minimizing risk, so our fund holders can grant more to the communities and the causes they care about, now and for years to come. Simply put, philanthropic resources generated by a high-performing investment program means organizations have the resources to meet their missions and students have the resources to achieve their education goals. The long-term success of our investment program is directly tied to the people behind it, and you will see many of them in action today. You will see how expert staff work closely with specialized consultants, and the process is led and guided by an investment committee that is composed of professionals with institutional investment experience who are drawn to serve in this role because of their deep ties to the region and the belief in the importance of Berkshire Taconic's mission. It's now my privilege to introduce Berkshire Taconic board member and investment committee chair, Liz Hilpman. Liz's leadership of the committee combines deep investment experience with an in-depth knowledge of community foundations and other endowed nonprofits. From this experience, Liz has led high-caliber investment programs that maximize resources that meet important challenges today and take a long-term view, recognizing that community foundation endowments are here to serve communities in perpetuity. Liz has over 30 years of investment management experience with Common Fund, Dartmouth College, and Global Asset Management. Since 2001, Liz has served as Chief Investment Officer and partner at Barlow Partners. Liz has served on the investment committees of the Nellie Mae Foundation, University of New Hampshire Foundation, and has chaired the investment committee at the Maine Community Foundation before chairing the committee here at Berkshire Taconic. I will now turn it over to Liz to provide an overview of the program. Liz, over to you.
Thank you, Peter. Good morning, everyone. I have to admit that it's odd not being able to see everyone's faces, but thanks for being on this call, and hopefully we can give you a good overview of what we do behind the scenes and for you on the investment portfolio at Berkshire Taconic. So we I couldn't do this job without the investment committee members, and importantly, with the help of Prime Buchholz, our investment consultant, and you will meet with many of the key people that work with us at Prime Buchholz. And so, but before I go on to introduce Prime Buchholz, I just wanted to just give you a slight overview, building on what Peter Taylor was saying with regard to the investment program. And as Peter said, this is a long-term investment portfolio, one that we spend a lot of time being very careful about how we diversify the portfolio. Importantly, that keeps us from losing enormous amounts of money, as you've seen happen in the last several months. In the marketplace. We have lost money, but we have lots of exposure to different strategies that don't all correlate together, and it's allowed us to provide really pretty outstanding performance over the many years that we've had the Berkshire portfolio in place. As many of you know, we have 3 investment options available for our constituency. The managed pool being the largest pool, the one where most of the assets are invested. But importantly, our socially responsible investment pool has been growing over time and has has taken on a lot more interest. And so we run that as a separate investment sleeve that is intended to be run as much as possible like the managed pool. And then we have the income pool, which is a very simple portfolio in that it only has fixed income, very short duration fixed income vehicles in that portfolio for people who would like a very risk averse approach to the portfolio. As I said before, the investment committee is really an important and critical part of the way we run Berkshire Taconic. And we have some incredibly talented volunteer members of the investment committee. And the next slide will just list the names of all the investment committee members. Some of them are former board members and are just now current they're advisors to the investment committee. And just very quickly, I just want to highlight the experience of this committee. Thad Gray has had his whole career was investing in private equity and venture capital, and has been instrumental in bringing some really important, hard to invest in names for us. Elizabeth Hewitt is the Chief Investment Officer of the Alfred B. Sloan Foundation in New York. Kelly Morgan has a very successful wealth management business in Boston, Mass. And also she has a home in the community. Ann Goodbuddy is a former investment committee chair and board member of the Berkshire Taconic, and had a very successful career in banking in New York. Seth Masters comes with incredible background and a very senior positions. Currently, I believe at AllianceBernstein. Tom Quinn has had a great career at JP Morgan and other places in real estate and private investing, and is our former chair, as many of you probably know, and former board member. And lastly, Daphne Richards comes with a vast background working in alternative investments at Bessemer, and now works for a large family office. So just giving you that background, I hope gives you some confidence that we have an investment committee with a lot of background, but importantly, a group that volunteers a tremendous amount of time for the investment committee, which meets at least 4 times a year and probably double that when we have special meetings. So I can go on, but with the interest of time, I'd like to pass it over to Prime Buchholz. And I have to say that the investment committee could not do without the help of Prime. They are an investment consultant that's been working with us for many years. And I'm going to pass it off to Kate Dumas, that has been our point of contact, the lead point of contact for many years. And she is backed with a really deep bench of folks, including Chris Shaw, who's been part of our program for quite some time. Kate is moving on, and we're sorry to see Kate move on. And we will find ways to stay in touch. But in the meantime, Tim Jarry is taking over and has a great background working with endowments and foundations and community foundations specifically. And so we are in great hands at Prime Buchholz, and we really are grateful for the way they've managed this transition, as well as worked with us all these years. So with that, I'm going to pass it over to Kate Dumas. Thank you, everyone.
Thank you, Liz, and good morning. It's good to be with you. As Liz mentioned, I'm one of 3 professionals from Prime Buchholz that you'll hear from this morning. I will give you a quick introduction to the firm and talk about some of the macro and market environment that we've seen. Pass it off again to my colleague, Chris Shaw, who's been with the foundation almost since the inception of our relationship back in 2007. And then we will pass it along to Tim Jarry, who is one of someone who has sat in Liz Hilpman's seat at a community foundation in Massachusetts, someone we got to know through that role, and was formerly the chief investment officer of Holy Cross. And so very excited to introduce that team to you. With respect to Prime Buchholz, as mentioned, we are an independent investment consulting firm. We are headquartered in Portsmouth, New Hampshire, and have about 125 employees across 3 offices, Portsmouth, Boston, and Atlanta. We are 100% employee owned, and we have an open architecture platform, which is really designed to serve foundations and endowments. In fact, we focus in the not-for-profit space and are fortunate to count Berkshire Taconic among 250 clients. And as you're seeing on this slide, about 75 billion plus in assets as of year end. It is our role to partner with the investment committee, as Liz mentioned, providing support on investment decision making. And we also serve as an extension to the foundation's business office. I will again spend a little bit of time on the macro environment, allow Chris to give you the update on the portfolios, both their performance and positioning. Tim Jarry will step in to talk about some of the things we're thinking about for the future, both in terms of what we're seeing across markets and perhaps some of the opportunities we may be seeing. So I will ask to advance the slides and provide a quick update with respect to the markets. What you are seeing here is a slide of the various major asset classes across which the foundation is invested. What's important to note here is you're seeing the year-to-date performance in blue. So this is the 2022 performance through May. And then the year performance, full calendar year 2021 in yellow. The purpose of this slide is really to demonstrate that we've seen a very marked turn across the markets, really starting at the end of last year. What you're seeing is, whereas the S&P 500 index was up almost 29% last year, thus far, at least through May, we're down about 13%. We're probably down another 6% thus far in June. And then as you look across the international markets, you'll see very similar outcomes. In the developed markets, positive 11% for that last year period. And then as we turn into 2022, really a drawdown across the markets. I think these numbers, and certainly the numbers we're seeing across newspaper headlines, can be jarring. Really important to note that as extraordinary as this period feels, when we take into account the market activity that we've seen even through yesterday, the S&P 500 index has compounded at an annual rate of about 13% over the last 10 years. So again, inclusive of this market drawdown, we've really seen the markets, perform and compound almost unabated since the global financial crisis. As we move down the page, you'll see the next segment, which is titled Flex Cap. This is the hedge fund or opportunistic bucket. Here, what you're seeing is, again, these are market results, but historically, these funds have participated on the upside, which you're seeing in the 2021 results, and protected on the downside. So certainly, as we're looking at those year-to-date results, outcomes that are slightly better than the equity markets. Right in the middle, we're capturing real assets. And one of the major stories, and something we'll touch on a number of places today, is really inflation. And with inflation expectations, we've seen some really positive results out of the natural resource and commodity markets. And these include the energy markets as well. And so as you think about what we've seen as you show up at the gas pump and fill your tank, that's really where this complex has captured a lot of that price movement. The last asset class at the bottom of the page is really the bonds market. And so we have a slide momentarily that shows the shift that we've seen in interest rates, both as a function of the market, with expectations of higher rates of inflation. We've also seen the Fed act pretty, markedly in terms of starting to increase interest rates at the short end, with the idea that that should help to tamp inflation. And so this has been, an interesting period in which, over the year-to-date period, you can see not only have the stocks or equities markets really corrected, we've also seen a tremendous amount of correction and pressure in the bond markets. And so accordingly, this has been a period where Chris will highlight the importance of having had some of the diversifying asset classes in the portfolio. If we jump ahead, we'll capture the performance of a variety of market segments. 2 points to make here on this slide. The first of which is right at the top. You can see the energy markets, positive upwards of 50% year to date. And then if you look down to the right, left bottom of the page, really the more growth-oriented sectors, whether healthcare, information technology, consumer discretionary, communication services, really posting some strongly negative results. And so accordingly, if you think about a value versus a growth style of investment, we've seen value outperform very markedly across the US and effectively all regions. If we jump ahead just one more page, you'll start to pick up the inflation slide. And what you're looking at here, that dotted line is the 555, which shows us the market expectations at any point in time for the forward 5-year rate of inflation. You can see that really since the end of 2020, that rate has ticked up. So market expectations around inflation have been on the rise, as we posted through May a year-over-year increase of over 8% in the CPI. You can see that continuing to track higher. I think what's encouraging on our end is, some of it being a bit more modest as we look out on the intermediate term, with the expectation from the markets that we probably end up with a long-term rate of inflation that's just about that long-term average of about 2 to 2.5%. So certainly something we're thinking about, certainly something we'll touch on in the portfolio. Expectation that we have higher inflation that we have had previously, but certainly not outside the realm of expectations. And then finally, the last chart that I'll share with you before I turn it over to Chris to talk about our portfolio is the next slide on yield curves. And so what you're seeing here is that yellow line, that is the yield curve from maturities out to the right to 30 years. And what you're seeing is, at the end of 2020, we were just about, not quite 1% on that 10-year. The entire curve shifted up for the end of 2021. So over the course of the year, we moved higher with rates closer to 1.5. And then certainly year to date through May, what we have seen is a much more dramatic increase. And so if you think about yields moving up, interest rates moving up, bond prices move in the other direction. And so that's really where we've seen a lot of that weakness as these rates reset. I'll turn it over to Chris now to bring you up to date on the foundation portfolio. Thanks, Chris.
Great, thanks, Kate. Hi, everybody. It's great to be with you today. What we wanted to do next is kind of give you a sense of how we think about portfolio construction and the asset allocation process. If we go to the next slide here, the investment philosophy is outlined. And the takeaways here really are, we're trying to build an all-weather portfolio that will do well in various types of market environments. So we're not trying to time the market. We're trying to build a long-term strategy that we can stick to that will do well in different types of environments. You'll see most of the assets are going to be allocated to what we would call the growth engine: public equities, private equities, hedge funds. That's going to help us get to our return goals over time. But we're also going to surround the growth engine with different types of hedges that will help in different types of market environments. In the top left, you see the green is certainly top of mind right now. Inflation hedges. The portfolio should have exposure to inflation capturing investments, things like real estate and resources, which as Kate outlined, those are some of the areas of the market that have done really well in the current environment. We should also have deflation hedges or flight to safety hedges, things like bonds that can be a source of liquidity for us and a ballast for the portfolio if we are going through a time of market stress. Also, dislocation hedges. Kate touched on the idea that the hedge funds in the portfolio have actually been very productive during this time. It's an opportunity where managers can capitalize on when the markets are declining and there's dislocation. They can be opportunistic and really add value. And then we also want some non-US international exposure in the portfolio to participate in other markets beyond just the US market. If we go to the next page here, we'll show you the current asset allocation of the portfolio. The actual allocations as of March 31st is on that left bar chart, and then the policy targets, or the target allocations that the committee manages to, are on the right side. You'll see the well-diversified portfolio, but as I mentioned earlier, most of the assets are going to be allocated to that growth engine, which is like that light bluish top half of the chart. That is the equities, both US equities, non-US equities, a little bit of emerging market equities, and a big piece of private equity, about 20% of the portfolio in private equity today. You see a meaningful allocation to the long short absolute return, that's hedge funds, about 20%. And then a little bit of core bonds and cash, really de-emphasized in the portfolio given what's going on with interest rates and the idea that our long-term goal is to cover our return objectives. As far as return objectives, what we're trying to manage to is a long-term goal of CPI +5. So the committee is thinking about returns net of inflation in real terms. So we're trying to earn a 5% return on top of inflation so that we can continue to maintain the purchasing power of the dollars in the portfolio over time. As we go to the next page here, we'll give you an update on the performance results in the portfolio. This is through March 31st. In the top right chart, we give you a comparison versus of the managed portfolio and the SRI pool versus peers. Tim's going to talk a little bit more about the SRI pool, so I'll focus on the managed pool here. But you can see really strong results for the managed pool across all time periods versus peers. That FAOG peer group is a peer group of similarly sized community foundations. And so we use that as our peer comparison. So you see the strong results across all time periods. In the bottom left, we also give you the performance snapshot, but we do it versus the policy index, which is the yellow bars, and then a simple blend of 65-35, 65% stocks and 35% bonds. And you can see that the results of the portfolio are strong relative to that. So what does that policy index mean? Policy index means if you were to achieve index outcomes or market outcomes within each section of the asset allocation targets that we looked at on the previous page, that's what that policy index would represent. So the performance over the policy index, it represents value add that the committee has been able to add over time. Performance improvement over index outcomes. As we go to the next page here, there's a couple ways that you can add value over time. As I mentioned, the committee has been able to add some value over the index outcomes over time. And there's two ways you can do that. So the first is through asset allocation, making asset allocation tilts that benefit the portfolio over time. And the second is through manager selection. So the committee is not choosing individual stocks and bonds. The committee is selecting manager specialists to implement that asset allocation. This is a snapshot of the attribution through the quarter. So I won't spend a lot of time on these specific numbers, but the takeaway being really that the committee has been very good at selecting managers and adding value through managers, but also has done a good job of adding value through asset allocation. And I'll show you an example of that. As we look at the bottom left of these three charts, you'll see the average active weight. What does that mean? It tells you whether the committee was overweight and underweight relative to the targets over the period. One area that the committee has really added value is by reducing the fixed income to the lower range and increasing cash accordingly. That's really helped us on our, given what's going on with interest rates over this time. And they also shorten duration or interest rate risk in that fixed income sleeve at the same time. With that, I will turn it over to Tim, who's going to talk a little bit more about the SRI pool.
Thanks, Chris. I appreciate it. And just as a reminder, everybody, across the bottom of your screen, there is a icon there labeled Q&A. If you have any questions, please feel free to put them in using that feature there, and we'll make sure to address them at the end of the presentation here. So this next slide, we just wanted to talk a little bit about the SRI pool, which is the socially responsible investing pool that the foundation manages for donors who are interested in investing with those guidelines. And you can see here a comparison of the SRI pool to the managed pool that Chris just walked through. We have the same long-term average return goal, which is 6 to 7% per year, but the asset mix is a little bit different between the two pools. And that's largely reflective of the size difference between the two pools, as the SRI pool is a bit smaller, obviously. So we have a larger allocation to global equity. You can see at 70% versus 50% for the managed pool. And that's the result of the fact that we really don't have an allocation to private equity within the SRI pool. We have seen that the donor interest there has increased, and assets have increased with it. And so we've started to look at some opportunities there to begin making some private commitments to grow that piece of the allocation, since it is a very meaningful way of achieving our return goals. You can also see that we have a little bit less in the flexible capital, which is the hedge fund category, but more within real assets, equal weighted within fixed incomes. The number of managers at 8 versus 45, again, is largely the result of not having that private allocation, since given the sizing of the private commitments that we make, it tends to increase the number of managers. And then you can see the lower fees there at 48 basis points versus 92 for the managed pool. And again, that's largely, it's not that the managers, equal managers are more or less expensive, as much as it is the lack of the alternatives allocation versus the managed pool, where the fees obviously in private equity and flexible capital are a little bit higher. So in terms of the principles that we govern this pool with, on the next slide, you can see that we're still focused on generating the same strong performance as in the managed pool, but doing it with that social responsibility criteria that we have there. And obviously also considering making a positive impact. In terms of the screens that are used in this space for what is not included, you can see about 50% of the portfolio is screened using what we call bright line screens. So these are objective screens that the foundation has control over. And so a number of our managers were able to specifically screen out based off of the list below that you can see there, in terms of things that are completely excluded, like nuclear power, carbon reserves, coal, tar sands, as well as excluding things that generate more than 5% of their revenue from gambling, firearms, alcohol, tobacco, et cetera. The other managers, the other 50% of managers, are largely ones that have mandates that are in keeping with these anyway. And so we're relying on those manager judgments. So these are specific strategies that might be targeted at people investing in this space. And so they're in keeping with our goals to begin with. And then, so what's the result of this, I guess? You can see on the next page here, the performance versus the managed pool being the first bar, the middle pool being the SRI pool, and that third bar, the darkest bar, being the performance of that peer universe that Chris described earlier. I think it is worth pointing out that all of these results here are net of all fees, all manager fees, our fee, any fee involved. So these are completely net returns back to the foundation. And you can see, I think, importantly, in that long period of time in the 10-year bar that, as Chris mentioned, the managed pool is ahead of that universe. And the SRI pool is ahead of that universe, even with constraints and restrictions we have in place. Outperformance of 40 basis points over that 10-year period is very significant. And it's something the foundation should really be proud of. You can see the returns in the near term 5 years have been a little bit behind that universe. And that's largely the result of not having that private equity allocation. In the last 5 years, we've seen private equity returns in the managed pool of north of 22%. And so obviously not being in that space dampens the return versus the managed pool, as well as the universe of other foundations that largely have private allocations as well. And then in the last couple of years, going back to Kate's comments at the beginning in terms of the macro environment, not having the energy exposure, particularly in the last 2 years, has held back the portfolio relative to peers as well here. But I think that's something we're very comfortable with. Again, as I said, the long-term returns are very good here. And we've been able to do that while keeping those restrictions in place that are important to the mandate of this pool. So just as we sort of conclude here and look forward, I think there's a few things we would point out as we think about the future in the next 10 years for the foundation. And so this next slide obviously talks a little bit about some of the risks that we're seeing in the environment. Kate talked about the Fed tightening, inflation, and the impact of those two things on global GDP growth going forward. Obviously, with the war in Ukraine, there's some geopolitical uncertainty there and elsewhere in the world. And recession being on the horizon, obviously can't open the paper without having that discussion. But we've been able to get to the performance returns working with the committee of the foundation by monitoring these market conditions, but not reacting to them. And I think having a good long-term strategic allocation is critical. We've been able to stick to that and really invest with that perpetual time horizon that the foundation has, which is a tremendous asset. And I think the committee does a very good job in shepherding the assets and making sure that we're maximizing the return. And this is a chart that we like to include because I think it really drives the point home. But in that bottom right-hand corner, you can see this is the S&P 500 performance for the last 20 years annualized. And you can see it's about 9.3% if you're invested for that full period of time. Over that 20 years, if you just miss 10 days, and this is out of obviously thousands of days, that performance would drop from 9.3 to 5.9. And if you miss the 50 best days, it would actually drop to a negative return of 1.4%. So really, this chart is just the cautionary tale of why market timing doesn't work, why we remain fully invested, and as Chris has described, why we try to build an all-weather portfolio that can survive different market environments. And so that's how we're positioned now. We're very optimistic that that's the right way to position the portfolio, and are confident that we'll continue to generate the types of returns that the foundation's been able to achieve so far. So with that, I'll pause and turn it back over to Joe to see if we have any questions that we can answer from the group.
Good morning, everyone. I want to thank our presenters, investment consultants, Kate Dumas, Tim Jarry, and Chris Shaw from Prime Buchholz, Liz Hilpman, our investment committee chair, and Peter Taylor, our president. Now we will respond to some of the questions we have received from participants in the Q&A feature. I encourage you to continue to add questions as we walk through some of the answers that we'll hear. The first question is, how is BTCF positioning the managed pool for this volatile market environment? Tim, would you like to take that one?
Sure, Joe, thank you. Yeah, I think I touched upon it a little bit. I think clearly we've seen volatility come back into the market this year. And I think that, as Chris described, that sort of hub and spoke model that we really focus on with the core part of the portfolio, the long-term equity allocation driving returns and those thoughtful hedges around it is our approach to this environment, in any environment for that matter. As I said, I think market timing is a very dangerous thing to get involved in. We don't think we're good at it. We don't think anyone's particularly good at it, candidly. And so we really strive to maintain that long-term strategic allocation, focus on good manager selection, and add value through that top quality managers. And we've been able to do that, and we're optimistic that we will be able to do that. And I think if we maintain that course, we should be able to continue to generate compelling returns as have been done in the past.
Thanks, Tim. The second question I have is, how is BTCF addressing inflation in our portfolios? Chris, would you like to take that one?
Great, thanks, Joe. Yeah, and I think it connects back to a couple of things that we talked about in this session here. The first being that long-term stick to the plan approach that we talked about. So we built the portfolio to have some inflation hedging and protective characteristics heading into this environment. It's really worked well for us. There is some energy in the main pool, some real estate exposure, things like that. Throughout some of the underlying managers, we're getting some of that inflation capturing protection. But also, as Kate outlined, the outlook for the market is that the inflation could potentially get under control potentially quickly. And so what we want to make sure we don't do is overreact and buy high on some of these energy and commodity prices. So we're sticking the course. The committee is very much evaluating this, thinking about how to adjust the portfolio, but it's largely sticking to the plan that's been working well for us.
Thank you, Chris. Another question is about why the SRI portfolio is lagging the managed pool. Tim, will you take this one?
Sure, Joe. Thank you. Yeah, it's a great question. And I think, again, as I said, the main reason over the course of the last 5 years or so has been the very strong returns out of private equity, which is an asset class that historically the SRI pool has not invested in. As we've seen growth in that pool and donor interest in investing in that pool, it's now getting of a size where we're beginning to start an allocation there. And so I would expect that would change going forward. And then I think the second reason I would point to, again, is that lack of energy exposure. That was a tailwind for a number of years as commodity prices declined. But as Kate mentioned in their opening remarks, in both 2021 and 2022 year to date, energy prices have been extremely strong. And so not having an allocation to oil and gas specifically has been a bit of a headwind, but one that we're not surprised to see in that pool given its mandate.
Thank you, Tim. One more question we have. It is, can you talk about why the private equity allocation is above the target in the managed pool? Chris, would you like to take it?
Yeah, I'll take that, Joe. Yeah, so the private equity allocation has been a big source of strength for the portfolio over the last several years, as Tim outlined. And there's a couple of factors contributing to what we would call an overweight. The first is that the committee has been building that position, thinking about increasing that target range. So running heavy there intentionally towards that upper range, as recognizing that it not only has been a source of performance in the past, but is expected to going forward. And then the other piece of it is, given what's going on in the markets, the private equity piece of the portfolio is slow to get marked down. So when the equity market is down 20% as we sit here today, the private equity piece of the portfolio doesn't get marked down as quickly. And so as a result, the private equity piece of the portfolio becomes bigger as some of the other categories around it become smaller. So kind of a denominator effect. So certainly something that the committee is evaluating. We have a very sophisticated model that we talk about at each meeting to talk about, where are we today? Where do we think the private equity allocation is going? Some scenario analysis, things like that. So committee is very focused on that allocation and balancing, not only is it expected to be a high returning category, but also, factoring in the liquidity characteristics of it as well.
Well, with that, I think we've run out of questions and come to the end of our program. I want to thank our presenters, particularly you, Kate, for your years of service to BTCF. It shows in the slides. Thank you. And to Tim and Chris as well. And to you, our fund holders who joined this webinar. We welcome additional questions or suggestions that will help BTCF to serve you better. Please feel free to contact me at any time to share your thoughts. Thank you for joining us today.